and we are going to start today with our personal lines homeowner. Now, this is a supplemental material for the property and casualty pre-licensing class. Now, it is not going to be state specific, and but I am going to point out some things because most of the items that we're going to be discussing here are all considering for all the states. All of the states will be using this information. Again, I'm Tammy Grosso DeLaura, and this is Tammy DeLaura Insurance Educators. Now, this course is not going to satisfy your pre-licensing requirement in your state. It is used only as supplemental material. Now, you're in the right place. If you've been struggling with the property and casualty pre-licensing state exam and you really, really want this career change, I know how hard it is to study for this class. There's so much material out there. So hopefully this will streamline for your important material. You have taken a self-study or classroom class, and again, there's so much material that it's very hard to figure out what is important. And you want a streamlined approach to what is important on the state test, and you want to learn the key points in each section. Now, keep in mind, this is general in nature. So about myself, I've been in the insurance industry for over 30 years, and I've been teaching insurance classes for 27 years. I'm actually a subject matter expert for Pearson VUE, and I've also purchased several insurance agencies in addition to owning this insurance school. So I can safely say that I'm in the trenches with you guys. I'm going to be using a lot of examples as we go through these courses so that you will understand exactly how to take this material and apply it so that you can pass the property and casualty test. I'd love for you to follow me on Facebook and LinkedIn. It's Tammy DeLaura Insurance Educators. Now, of course, this is one of my favorite sayings: you are not too old, and it is not too late to learn this information. A lot of people say, oh, I'm just so old, I cannot grasp all this information. You can. I have been teaching, like I said, for over 25 years, and I've had all kinds of people in my classes, some that were experienced, some that were not experienced, some that were very young, some that were very old, and it's just all about what you put into the class. Now, of course, I have to do a disclaimer that with insurance policy, things do change with court decisions and also with policy forms. You do need to consult your advisor for any type of legal or tax issues and that type of thing. Now, the very first thing we're going to talk about is the homeowner policy, because they're usually, as far as the property section, now you may have a state where it's one test and the property and casualty are together, or you may have a state where it's just property. But the homeowners is usually a good percentage of this property test. So we're going to spend some time, and I think you should notice that we should spend some time on your homeowner policy. So the eligibility, the homeowner is a multi-line policy. Now, as we go through policies, you're going to hear, is this a property only policy, or is it property and liability combined in a single policy? So a lot of your policies that we'll talk about, like mobile homes, that is a property and liability policy, that type of thing. So like dwellings, when we get to dwelling policies, it's only property. But when it comes to homeowners, it is a multi-line policy because it provides property and liability in a single policy. Now, the thing that you have to remember about homeowner policies is the named insured must be the owner occupant of this dwelling or condominium or renter who maintains occupancy. So in other words, if Tom Smith comes into my office, one of the first questions I'm going to ask Tom is, do you own this home as far as living in this home, or are you renting this home out? And if he says, well, I will be living in this home, then that will be owner occupied and we can put him on the homeowner policy. If he says, no, I'm not going to be living in this home, but I will be renting it out, then we know that we cannot put him on a homeowner policy and he will go on a different type of policy, usually called a dwelling policy or a landlord policy. Now, on these homeowner policies, we can write the homeowner forms, people that live in the home, or we can write people that live in condos. Those are going to be your HO6s. We can also write renters, which is kind of weird because it says homeowners. So renters, again, we would ask Tom, and he says, I need some renter's insurance. Maybe his apartment complex is suggesting that he has this, or they're requiring that he has renter's insurance. So he says, I need some renter's insurance. And that's, again, one of the questions we're going to ask him. Are you going to be occupying this apartment? You're not going to be subleasing it or that type of thing. So it's very important on these homeowner policies that they are owner occupied. Now, when we're talking about a homeowner policy, we can do up to 4 family units. You've seen these buildings, maybe they're called, homeowners associations as far as townhomes. And there's usually 4 family units to each building. And then there's up to 2 roomers or boarders that you can have. I've got a friend, and what they do is they rent their home, and they are empty nesters. So they have converted 2 of the bedrooms, and they rent these bedrooms out to boarders. So you can have up to 2 roomers or boarders typically in a homeowner policy. Now, with these homeowner policies, we're going to see that they are package policies, and it is a take it or leave it type policy. So you cannot just purchase personal property. You can't say, well, if I am buying this home, I don't want to have any insurance on the home. Maybe you paid cash for it and you do not want any insurance on the home itself. Now, I don't know why you would do that, but you can't split it out like that. It is a policy that's going to have dwelling, personal property, and some other coverages on there. The only time you can do that is if you are a renter. Now, this dwelling or this home that we're going to be insuring is very important that it's used exclusively as a residence, except for incidental occupancy such as offices, professional, private schools, or studios. Main thing is you can't have any commercial or manufacturing in here. So yes, you can have an office. A lot of people are working from home, that type of thing. Now, when it comes to farms, farms are considered businesses. Now, I'm not talking about the person that says, oh, I have a farm. And in their farm, they may have a couple chickens and cows and things like that. This is a true farm, like a dairy farm or a farm where they are raising cows and they are going to be selling the meat and that type of thing. So farms cannot be covered on this policy. They have to be covered on a separate policy, which of course is called a farm policy. Now, most companies will not let you put mobile homes on a homeowner policy. Usually they want mobile homes on their own mobile home policy. But there are some situations where you could have a mobile home if a company approves it. Company has to say, yes, we're okay with putting these mobile homes on our homeowner policy. So the company will approve it, and then they will put an endorsement on the homeowner policy, which basically says, hey, we are insuring this under homeowner form, and this is a mobile home. Now, these homeowners that we're insuring, they can be under construction, and that doesn't mean a piece of land and the building's going up for construction, because we're going to put those on a builder's risk policy. But what that could mean is maybe the basement's being finished, or maybe they are gutting out the kitchen and the bathrooms, and those are being remodeled, that type of thing. It can be a second home. It can be seasonal, meaning that the homeowner is only going to be there, maybe in the summer months or in the spring months or that type of thing. Now, there are a lot of people that are covered under this homeowner policy, and it's not just the named insured, like our Tom Smith that we use, for example. It would include the spouse, as long as they live in the household. It would include residents of the household. Maybe it is their mother that lives with them, or maybe an uncle lives with them. Also, anyone aged 21 and under in the care of the insured. So what does that mean? That means like a foster child would be a great example for someone that is in the care of the insured. And their things would be protected as well. Now, there are a lot of forms here that are available for the homeowner policy, and each form will have identical liability coverage, which we'll talk about in just a moment. But perils are the main difference in the homeowner form. So what do I mean by that? Perils are things like fire and lightning. And those are the main differences in the homeowner forms. So what I'm going to do is I'm going to tell you what Section 1 property is and what Section 2 liability is. And then I'm going to circle around and tell you what each one of these specific homeowner forms mean, because that is going to be your difference. So what we're going to do going forward is it doesn't matter if you write an HO8 or an HO2 or an HO3 or 4 or 5 or 6. What we're going to talk about is both of these forms, all of these forms, I should say, includes Section 1 and Section 2. So we'll circle back around and talk about these different perils in just a little bit. Now, all of these forms have a Section 1, which is your property. And these are coverage items and also some additional coverages that we'll talk about as well. Now, some of your coverage items that we're going to be talking about are your dwelling, other structures, personal property, and loss of use. Now, this means that they only have one deductible. So if there is a fire and it damages the home itself and it damages some other structures and some personal property, then there will only be one deductible. In other words, the insured will only have to pay out, for example, $1,000 for that loss, only one deductible. They're not going to apply a deductible for dwelling, other structures, and then another one for personal property. So there is one deductible. Now, this coverage A, B, and C are called your direct coverages. And we'll get to what direct coverages means as we do our terms and conditions a little bit later. And then your coverage D is going to be called your indirect coverage. And again, we'll go over that in just a little bit. Now, your coverage A, which is your dwelling. So this covers a lot of things, not just the home itself. It covers structures that are attached to the dwelling. It covers materials and supplies that are used in construction or repair of the dwelling. So let's say that you are finishing off that basement. You have some drywall and your drywall gets stolen, or maybe you're going to construct another shed that's not even attached to the dwelling, and that type of material gets stolen. Well, then it would still go under the coverage A, dwelling. So it not only includes the dwelling itself and the structures attached to the dwelling, but it also includes materials and supplies for use in the construction or repair of the dwelling or other structures. The other thing that is thrown into this dwelling coverage A is any outdoor equipment to service the premises is also including this limit. So that would be lawnmowers and tractors would be great examples of that. I actually have a client call up once or twice a year, and maybe they've bought a really nice, expensive tractor. And how are we going to insure that? Well, as long as it stays on the premises, it's not used for commercial use, then we can put this under our coverage A, dwelling. Now, our next coverage is coverage B, and this is your other structures, and everything goes off of coverage A. Now, other structures is 10% of coverage A. So, for example, to make it easy, if you have a home and it's valued at $100,000, then your other structures will automatically be $10,000. So these are buildings that are separated from the dwelling by a clear space. And again, this building cannot be used for commercial, manufacturing, or farming purposes. It cannot be used for business purposes. So what do I mean by that? If you take your shed or your other structure and you turn it into a auto mechanic shop, or you turn it into a beauty salon, these are things that will not be covered under your other structure. So if there's a fire and you have that particular operation in that other structure, it will not be covered. Companies are getting very, very strict about that. So you cannot use this for business purposes. Now, you'll just have to get other insurance for that. But again, those other structures should be used to put, maybe your lawnmowers or your tractors or your Christmas decorations and things like that, that we put in other structures. It cannot be used for commercial, manufacturing, or farming. Now, some examples of other structures are fences, swimming pools. You could have other structures as being tree houses. I've seen that on the state test as well. Now, what is coverage C? And again, all of this is included in your Section 1 property, and all of your forms, all of your homeowner forms have all of these coverages. So personal property is 50% of coverage A, and it provides coverage for personal property owned or used by an insured or anywhere in the world. So again, if you have a $100,000 dwelling, then you would automatically have $50,000 for your personal property or contents. Maybe you could hear the word contents as well. So again, your personal property can go anywhere. If you take some property and you put it in your suitcase and you go over to Europe and some of your things get stolen, it will be covered because it is anywhere in the world. Now we have our coverage A, our coverage B, and our coverage C. So those are coverages that are going to be insuring our property. So what happens, for example, if let's use the peril of fire, that there is a fire and we cannot stay in our home and we have to go live somewhere else while our home is being repaired. What happens then? Well, we'll probably go stay in a hotel. And that's what loss of use is for. But again, something up here has to happen, like a fire, for loss of use to kick in. And so loss of use, the unendorsed form is 30% of coverage A. And again, it's going to depend on what forms you have, whether you have a homeowner 2, 3, or a 5. Now in North Carolina, it's 20% in North Carolina. So if you have to go to a hotel and stay, then you would have, and again, your dwelling's 100,000, you would have 30,000 in states like North Carolina. So be sure to check your state. You would have 20,000 for loss of use for hotel expenses while you were staying there. But again, it would only be for these homeowner forms 2, 3, and 5. And then it's 10% for homeowner 8. Okay. And then it's 30% for coverage C for homeowner 4, because that's a tenant. And then 50%, which is 40% North Carolina, of coverage C for HO6. So I'm going to come back through these again, and we're going to go through those when we go through the definite homeowner forms and what they are. So we'll circle around back to loss of use. But for now, keep in mind that loss of use is because you had a direct loss up here with your dwelling, other structure, or personal property. And now you have to go, for example, and stay in a hotel. Now, in addition to having those great coverages for your dwelling and your personal property and your contents, if like there was a peril that happened, you'll also get some additional coverages. And usually these are no deductible, that's included. These are in addition, and there's no extra premium here. Again, these are written in the policy. One of them is debris removal. So you've had that fire, and that's great that you can repair your dwelling or your home there. That's great that you can replace your personal property, your contents, your furniture, your clothes, and things like that. But what about debris? And there's usually some debris, whether it's left from a windstorm or a fire. So this coverage is included in the limit that applies to the damaged property. And this is the deal. If that limit is not enough to pay for the actual damage of the property, plus the debris removal expense, an additional 5% of that limit is available. And then I gave you an example here. The property suffers a total fire loss. The limit is $60,000. And the homeowner is responsible for an additional $1,500 debris removal. So the policy pays $60,000 for, and the $1,500 for the debris removal. Now there would be up to $3,000 because again, they've used up their limit, but they get an extra 5% if they need it. Now they didn't need it here. They only needed $1,500. So they're not going to get $3,000 if they don't need it. But if they need it, they'll get that extra $3,000. So keep in mind, debris removal is including the limit, but if you go over that limit, you do have 5%. Now, reasonable repairs, for example, buying a tarp to cover a hole in the roof or hiring a contractor, would be some additional coverages. There's very, very limitations on this tree, shrubs, and other plants. It is usually by the perils of fire, lightning, explosion, riot, aircraft, vandalism, theft, and auto not owned by a residence. It's 5% of coverage A, not to exceed $500 for any tree, shrub, or plant. So if there was a situation like a windstorm, of course, that won't be covered. It's just for those perils there. If for some reason you need to call the fire department and it is not covered, maybe through taxes, some people have private fire departments, some people will have volunteer fire departments and they charge you, it will pay up to $500 for fire department. If for some reason you need to remove some of your property and your property has to go into a storage facility, and you just don't want that property to get smoke damage, a company will be glad to do that because they would rather pay for storage than to replace that property. So property removals for 30 days. Now you may want to put a note there. This is for any peril. Now we're going to talk about how things like perils like earthquake and flood are excluded, but this is for any peril. So even though your homeowner policy excludes flood, which we'll get to, if there is a flood at this warehouse, guess what? Your property is covered because it is any peril. So be sure to remember that because it is on most of your state tests there. Loss assessment, which is $1,000. Not everybody has a homeowner association. So, but what they do is if your homeowner association does assess you on the property side, your policy will pay up to $1,000. So what does that mean? Let's say you have a clubhouse and there is a homeowner association, or there should be, on this clubhouse, because that is property that is everyone's. And for some reason, maybe that insurance expired or it lapsed or someone just didn't take it out. And then the clubhouse has a fire. And so since they don't have any insurance, they assess each homeowner for $5,000. Well, your insurance policy will pay $1,000. So keep in mind, $1,000 is automatic in your homeowner policy. Now, you can increase that with an endorsement and with additional premium, but as far as the state test is concerned, you only have $1,000 automatically. So these are your additional coverages. And again, they are debris removal, reasonable repairs, a little bit of limited peril coverage on trees, shrubs, and other plants, fire department, property removed, and loss assessment. Now, even though you have coverage C, which is your contents, which is your stuff, think furniture, think TVs, think computers, that type of thing, you are going to be limited on that coverage C. Now, these limitations do not reduce coverage. I mean, they do reduce coverage, but they do not eliminate coverage. So what does that mean? Your property is limited to. So the following personal property has special limits of liability for any peril. That means if there's a fire, if there is a theft, if there's vandalism, it will be covered and it will be very, very limited. And one of those is money. So you have $200 for money. So even if you had, for example, a $50,000 coverage C contents limit and someone steals your money that was under your mattress and there was $10,000 under that, you can see why they limit money. So it's $200. And for any peril, $1,500 costs to research, replace, or restore information. $1,500 for watercraft, which is your boats, which includes trailers and equipment. The best place to put a watercraft policy is on a boat policy. But if you do not do that and there's a fire and your boat is damaged in the fire, then they will give you up to $1,500 under your homeowner policy for watercraft. And this includes trailers and equipment. Now, $1,500 for trailers not used with watercraft. Most of your trailers are going to go on your auto policy, your personal auto policy. But if for some reason you did not put that trailer there and there was a fire, then it would pay up to $1,500 for your trailers. Again, we do not want business operations like commercial and manufacturing or homeowners, but there may be situations where you bring home some property from your business, maybe a laptop or some samples or things like that, and there's a fire at your house, then it would cover under your homeowner policy a limit, it would limit it to $2,500 property on the premises, and then $1,500 for property away from the residence premises used for business purposes. And again, these things that are limited, these contents, this personal property that's limited, is for any peril. Now, they will limit these next things that we're going to talk about, but only for the peril of theft. This is for the peril of theft only. So if your jewelry or watches burns up in a fire, then it would go under the contents limit. But if it were to get stolen, same thing with your silverware and your firearms, then they're going to limit it for the peril of theft. And how does that work? Well, $1,500 for jewelry, watches, furs, precious and semi-precious stones, $2,500 for silverware, goldware, or pewterware. Now, in North Carolina, and you may want to check your state as well, they will give you $10,000. So you guys that are taking tests in North Carolina, you're going to put for theft $10,000, and the same thing for firearms. It will be $10,000. But for most of your states, it's going to be $2,500 and $2,500. So again, this is property limited. These are property that reduces coverage. They don't eliminate coverage, but they definitely reduce that coverage C contents limit. And some are for any peril, no matter what happens to it. That's the peril that it covers. And then some are just for theft only. So be sure to differentiate between any peril and theft only, and know what is excluded, or not excluded, but limited for any peril, and what is limited for theft only. Now, there's just some things that will not be covered because usually they're covered on another policy, or you just can't cover them. One of them is animals, birds, and fish. So if you have an exotic bird and your bird were to get stolen, that's not going to be covered. Any type of motorized vehicles or aircraft, you should have under a personal auto policy or a personal aviation policy, or commercial if you're doing it for business. Property of borders. Remember, I told you there could be two borders there. Now, that's a great thing, but what if there's a fire and your borders or your renters, their stuff is damaged in a fire? Well, that is not covered. Okay, it's only your things. Same thing with property and apartment held for rental by the insured. Hovercraft, things like drones, are not covered. Property normally kept at a residence premises, other than the residence premises shown in the deck, is covered for up to 10% of coverage C limit, or 1,000, whichever is greater. Now, what does that mean? Let's say that you have a home and it's insured, and then you buy another lake home, and you're thinking, well, my contents coverage will go anywhere in the world, so I'm going to move some of my contents over here and not put any insurance on my lake home because I don't care if anything happens to that dwelling. We're going to tear that down anyway. So if there is a fire and you do not have any insurance on this lake home over here, what they will do is they will only cover it for up to 10% of coverage C that was on the home. So if you have a $50,000 coverage C that was on the home, it's only going to cover it for 10%. So they would only cover $5,000 on that lake home where you have no coverage. Okay. So we'll talk about why they do that, how we're all sharing in each other's expenses a little bit later. However, this restriction does not apply to property being moved from the residence premises to a newly principal residence. So in other words, if you put all your things on a truck and you're moving it to California and you live in North Carolina, it will cover that. I get asked that question quite a bit in our agency as well. Now, we're going to talk about perils a little bit later, like fire and lightning and theft and all of those types of perils. But some of your perils that are just going to be excluded and not covered at all is your earth movement, which means earthquake. Any type of water damage, which includes flooding. What we're going to find out about flooding is that we have to put this in a separate policy. Flood is going to be a separate policy. Also, overflow from a sump pump or water backup. You may hear both of those. Those are also excluded. Now, with flood, we can write a separate policy. With water backup and overflow from a sump pump, we're going to find out that we can endorse that to our homeowner policy. Power interruption that takes place off the residence premises. This is such a tough exclusion for my clients because let's say that there is a huge ice storm and they just bought a bunch of meat and put in their freezer and there's a power failure. That is not covered. That spoilage of food is not covered. So that is not covered, but you can put an endorsement on your homeowner policy. It's usually called refrigerated property to cover that. So that's a tough exclusion. The insurer's failure to save and preserve property after a loss. Now, remember, we talked about how you can, for reasonable repairs, get reimbursed for that. If you need you don't have to put a tarp over your roof. You can hire someone to do that and you will get reimbursed. But if you fail to do that because you're thinking, well, there's this big hole in my roof and I'm okay with my property getting damaged because I want some new property, then an insurance company could come in and they could exclude that, which again could be a tough exclusion. War is excluded, nuclear hazard, intentional. If you set your own house on fire, again, all this makes sense. I call those common sense exclusions. Destruction, confiscation, or seizure of property by the government or public authority. You know, when you're watching TV, sometimes you'll see these agents bursting through somebody's home, and that is not covered. That type of damage to the property is not covered. So these are some perils that are excluded in your homeowner policy, and they're just not covered at all. Some of them because we can write extra policies for, and some of them, like intentional, you just don't have enough premium to insure someone that intentionally destroys their property. Now, remember, I told you that we were going to talk about the different forms and the relationships among the forms. When it comes to a dwelling, this is going to be your primary limit, and they will give you on the state test what that limit is. And then your other structures will be automatically 10% of coverage A. Your contents will automatically be 50% of coverage A. And depending on what form you have, your loss of use. Now, remember, what is an example of loss of use? You've had that fire and you can't stay in your home while your home is being repaired. So you go and stay in a hotel. Now, for your HOs 2, 3, and 5, it's going to be 30% of coverage A. Now, North Carolina is 20%. Now, your HO8 is going to be 10% of coverage A. Your HO4, which is going to be your renter's policy, and I'll go through these in a lot more detail in just a moment. This is 30% of coverage C, or 20% if you live in North Carolina. So again, this is a renter's policy. They're not going to have a coverage A dwelling and a coverage B other structures because they are renting. You know, they live in an apartment, for example. And then your HO6 is your condo policy. And your condo policy, what happens there is if you own a condo, the condominium association is the one that insures the condo. So they're basically insuring your dwelling. But you still, as an owner, have to have insurance on your contents and your loss of use. So you're not really a regular homeowner. But you're not a renter. So for your condos, they have their own policy called an HO6. And this is going to be how their loss of use is going to be calculated. It's going to be 50% of coverage C because coverage C contents is their main limit for your dwelling. For your HO4, which is a renter's policy, and for your HO6, which is a condo. So that's all going to be coverage C. And then they give you a little bit more coverage for coverage C. Now, remember, North Carolina, you guys have a little bit of a different percentage there. Now, for your HO4 and HO6, again, your coverage A dwelling and your other structures is not applicable. You do on your condo, your HO6, you do have a $1,000 limit. Now, some states may be $5,000. So be sure to check your states, but they will give you an automatic coverage of that. So for your HO4 and HO6, coverage C is your primary limit. Now, remember, the homeowner form also provides a deductible, and your typical deductibles are $1,000, and they are for per occurrence. So each time you have a loss, that deductible resets itself, and it's going to be $1,000 or more, depending on what your client chooses. Okay, so what we're going to do now is we're going to go back up to these forms that are available. So when we have these forms, again, perils are the main difference in your forms. Now we're going to start down here at our HO8, which is our basic form. It is a form that is not used very often. It replaced the HO1, and it is called the basic form. And the perils are fire and lightning. And then we have an acronym called WARVs. Now, this acronym called WARVs is your windstorm, hail, aircraft, auto, riot, volcanic eruption, explosion, and smoke. So again, the way to memorize that is WARVs. So it's going to be fire, lightning, and then you can just go windstorm, hail, aircraft, auto, riot, volcanic eruption. explosion, and smoke to help you memorize those. And then you have vandalism, malicious mischief, and you also have theft. Now, on all of your HO forms, all of your homeowner forms are always going to have theft. When we get to commercial, that may not be the case. When we get to dwelling, that's not the case. Okay, so again, your HO8 is your fire, lightning, wharves. So if something happens to your home, an airplane hits your home. You've heard of those happening. Someone's auto hits your home. Okay, all of these things are covered under your HO8 basic form. Now, if it's not, the peril is not listed there, then it's not covered. All right. Whereas in your HO2 form, it's called a broad form, and you have all of these perils. So you have fire, lightning, our acronym of wharves, vandalism, malicious mischief, and theft. And then you have the HO2, which is your broad form. So this is all your basic perils, all these perils down here, plus burglary, ice, snow, sleet, glass, accidental discharge of water. So let's say that your dishwasher or your washing machine overflows. Okay, all of these have to be sudden. All right, freezing of plumbing and related systems. So let's say that your plumbing system or your pipes froze. Okay, it's not the drip drips in the wall that all of a sudden you see a spot, tough claim, that's excluded. And you peel it back and you've got a lot of mold and this has been dripping for a long time. That is not going to be covered, and that is a tough exclusion, but it has to be sudden. Okay, falling objects are covered, artificial generated electrical current, collapse and tearing apart. Okay, these things are covered, like heating systems and things like that. Now, the covered perils are again for your dwelling and personal property for all of them. So the way I always tell people to remember this type of big effect, these types of perils, is to use the acronym BIG effect, because that will help you remember these perils here. So B is burglary, I is ice, snow, sleet, G glass, accidental discharge, freezing, falling objects, artificial electrical current, collapse and tearing apart. Okay, just a great way for you to memorize those. And again, when it came to the basic and broad form, these are for your dwelling, your coverage A, your coverage B, other structures, and your coverage C, personal property. Now, your HO3 is called a special form, and what they do is they split it out. So it's open peril coverage for the loss to dwelling and other structures, meaning everything's covered that's not excluded. So I'm going to use a wild example here. Let's say that a deer runs through your house and tears up your wall and your flooring. And then it jumps on the couch. Again, we're going to be extreme here, and runs through the closet and tears up your property. Now, a deer running through the house would not be covered under your basic or under your broad peril because there is no deer peril. But your HO3 form could cover that for your dwelling, and it could cover that for your other structures. Because if it were to come in, the deer, and it were to tear up your walls and your flooring, then it could possibly be covered under your HO3. And again, I'm just using that as an outrageous example because it covers everything that's not excluded for that coverage A and B. Now, what is excluded? Remember, intentional, war, nuclear, flood, earthquake, all of those things are excluded. But then we go back to the broad coverage for your personal property, which is all of these perils plus these perils. So that deer, if it jumps on the couch, it is not covered because we're going back to these perils and these perils here. Okay, so they're identical to the HO2. So one of the things that you can do is you can put an HO15 on this HO3 policy. You only can put it on HO3. And what it does is it now takes your contents to open perils. So now if that deer runs through the house and it tears up your walls and your flooring, then yes, it would be covered because you have open perils for those. And then if it jumps on the couch, now with an HO15, it would be covered. So just kind of remember that example. It's a little bit outrageous, but I think it'll help you with the HO3. Now, your HO4 is a contents form. It is for your renters. These are people that rent. They do not own the building, so they don't need coverage A, dwelling. They don't need coverage B, contents or personal property. Coverage B, which is other structures. They don't need either one of those. But what they do need is coverage C, which is contents and personal property. And again, it provides coverage on broad form, which is your basic perils here: fire, lightning, and wharves, and vandalism, malicious mischief, and theft. And then all of these perils up here, which are your big effect. Now, you'll just have to sit down and memorize these. It's not going to come to you automatically. You have to just repeat these perils to yourself over and over again. Now, your comprehensive form. Your comprehensive form is basically your HO3 with your HO15. You think, well, why don't we just write an HO5? Well, some companies are filed with an HO3 plus an HO15, which basically is an HO5 comprehensive form. So this provides open perils for the dwelling, other structures, and personal property. It is the best and broadest form. So now when that deer runs through the house, and if it tears up your flooring and your walls and your personal property, it is covered because it covers everything that's not excluded. It is an open peril coverage policy. Your HO6 is that condo policy. And again, your condo association is going to cover your building. So it provides broad coverage, this basic perils, plus your broad coverage, all of your broad perils on the personal property of the condo owner. Now, there is typically $1,000. Sometimes there's $5,000 on the dwelling coverage. So just check with your companies on that. Okay, so we talked about relationships, and now we're going to talk about loss settlement. And your loss settlement is whether this is actual cash value or replacement cost. Now, what is actual cash value? Actual cash value is that situation where maybe you have you will not get any type of replacement cost. So actual cash value is replacement cost minus depreciation. That is actual cash value. And then, of course, replacement cost does not take depreciation in consideration. So there is no depreciation when it comes to replacement cost. So that means if you have let's say you have a couch, and if you have ACV and that couch is 10 years old and it costs $1,000 to make it easier to buy a new couch, then they could take away $500 for depreciation and only give you $500. If you have replacement cost, there is no depreciation. So when it comes to this very basic form, this very basic HO8 form, which is your dwelling, your other structures, and your personal property are all settled on an ACV basis. And then your HO2 and HO3, your dwellings and your other structures are settled at replacement cost as long as the insured carries 80% or more of the full replacement cost of the building, which we'll talk about. But your personal property is still ACV. And on your HO4 and HO6, your personal property is ACV. Now your HO5, everything is replacement cost. And this is called the unendorsed form. This is how the policy comes automatically. Now, if you want replacement cost, you will have to, you can endorse that, but it will be additional premium. Okay, so again, those are your loss settlements, and that is called your unendorsed form. Now, switching gears a little bit here, what are some of your duties following a loss? Well, you need to give prompt notice of claim to the insurance company or agent. You need to protect the property from further loss. You need to complete a detailed proof of loss, which is an inventory of your damages. You have to make the property available for inspection by the company. If the company requires it, you have to submit to examination under oath, and you have to assist the insured during this claim investigation procedure. Now, basically, the insured can collect the lesser of insurable interest, policy limits, actual cash value, or replacement costs, depending on what valuation of the policy limit has been established. One of the things you have to keep in mind, if you have a $20,000 limit and the loss is only $10,000, they're going to give you the lesser of the policy limit or the loss. You're not going to get the policy limit if you have a loss that's less than that. And sometimes you'll see that as a tricky question on the test. Now, there are some mortgage duties. Lenders and mortgagees may have insurable interest in the property. The mortgagee is generally named in the declaration because they usually have just as much or more interest as the insured. The mortgagee condition specifies the rights and duties of the lender under the policy. They also have to be notified if there's a proof of loss has been filed by the insured, because they want to, sometimes they'll go back in and check and make sure that that loss has been settled and that that insured did repair that floor and didn't just pocket the money. If the insurer denies coverage, the insurer is the insurance company, for a loss that would otherwise be covered, the mortgagee may still have protection. So if the insured did intentionally set fire to their home, there could be a chance that the mortgagee could also be protected under this policy. So again, that mortgagee has a right to have their name on the check, and they have a right to receive cancellation notices from the insurance company. Now, what is coinsurance? Well, insurance companies want to encourage their policyholders to insure their property to full value. Since partial losses are more common than total losses, some insurers might want to purchase minimum insurance to take care of these small losses. Basically, they're gambling or taking a chance that they will never suffer a total loss. Now, I will tell you, in my agency, and I have been an agent, I've been in insurance for 30 years, and I've been an agency owner for 16. I've only had 2 total losses. One was a windstorm that the home was totally destroyed, and then one was a fire loss. And most of my losses, well, all of them, except for those 2, have been partial. So what would keep someone from saying, well, I know I have, and we're just keeping it simple, this home that's valued at $100,000, but I'm just going to put insurance on $50,000. And because that should cover most of my losses. Again, that's a gamble, and insurance is not about gambling. You have to remember that we're all in this together. So we're all contributing premium into the bank, if you will, which is the insurance company, and then they are paying out losses. A lot of times I'll get calls from clients that will say, why did my premium go up? I haven't had any losses. Well, you will always have the lowest premium if you keep continuous insurance, if you have good credit. Unfortunately, a lot of companies will, use that as part of your premium. So if you have good credit, if you have continuous insurance, if you have no losses or a few losses, you always have the best premium. But we will all, pretty much your premiums are always going to go up because we're all contributing into each other's losses. So insurance companies, which is very actuary driven, have to have enough premiums to pay out everybody's losses. And this is the law of large numbers. So what they do is they say, okay, we want you to carry at least 80% of value or 90%, which they are basically compromising. They're letting you carry, instead of 100,000, they're letting you carry 80,000. Now, what if there's a total loss? Well, the insured is sharing in that limit. They would pay that other 20,000, right? So sometimes, mainly in commercial, insurance companies will let you carry 80 or 90%. Most insurance companies want 100% value in the property. They want you to carry your full 100% replacement cost value. Now, as long as the insured carries this minimum amount, whether it's 80, 90, or required 100%, the insurance company will identify losses and they will not penalize for partial losses. So basically, the insurer sustains a portion of the limit if they're doing 80 and 90%. With a deductible, the insurer sustains a portion of a loss. So I want you to remember that, because that is tested on quite a bit. Basically, the insurer sustains a portion of the limit when it's coinsurance, and they sustain a portion of the loss when it is a deductible involved. Now, let's look at this a little bit closely. Coinsurance is a basic insurance concept that helps insurance companies make sure properties are insured to value. Most losses are partial losses versus total losses. Many insurers might opt to pay for lower amounts of coverage. For example, Mr. Smith has a building value of $100,000. We're just making it simple here. He insures the building for $80,000 because they have given him a co-insurance limit of 80%. And he has a $1,000 deductible. He has a loss of $10,000. So how does this work? And I always say it is the carried amount, what the insured carried, divided what they should have carried, what the amount of insurance required, times the amount of loss, minus the deductible equals payment. So in this particular case, he had an 80% co-insurance. So he carried 80,000. What was he supposed to carry? The insurance company said he could carry 80,000. So he was supposed to carry 100,000 times 0.80. So he carried what he should have carried. If you take 80,000 divided by 80,000, that's 1. A number divided by itself is 1. So it's going to pay this full loss minus $1,000 deductible. So it will pay $9,000. He is what they call adequately insured. So he will not be penalized for losses. All right. He will not be penalized for any type of losses. Now, let's say that Mr. Smith insured the building for $40,000 instead of the adequate amount of $80,000. Well, we can already tell he's underinsured. So he insured it for $40,000. And if you divide that by 80,000, that's only 50% that's going to be paid for that loss, minus his deductible is going to be $4,000. So what are they doing here? They are penalizing him for partial losses. Because don't forget the concept, even though he has a $40,000 limit, it is more than enough to pay the $10,000 loss. But he didn't carry what he should have carried, so they are penalizing him for partial losses. So that co-insurance is very important because they will penalize you for partial losses. Plus, with the HO2 and the HO3 form, if you don't have replacement cost on your building, you won't, if you do not have the right co-insurance, you will not get replacement cost. So not carrying the adequate amount of insurance will result in the insurance company penalizing the insured for partial losses. All right. If the problem does show ACV, be sure to compare the ACV to the final answer and go with the highest number. So let's say that ACV was 5,000, then they would go with 5,000. If ACV was 3,000, then of course you would go with the formula number. Some insurance companies have 80% or more co-insurance. The purpose is to repair or replace damage to a dwelling without regard to depreciation, providing insurance in the amount of 80% or more the replacement value is carried. So there's two things that you have to remember with co-insurance is when you have a particular homeowner form like an HO2 or a 3 or a 5, they will let you have replacement cost on your buildings as long as you have a minimum of 80% co-insurance. The other thing is you have to have the adequate limit or they will penalize you for losses. Keep in mind, an insured will sustain a portion of the loss with a deductible. An insured will sustain a portion of the limit when you have co-insurance. When it comes to vacancy, insurance companies do not like vacant homes. If you find out that one of your insureds is moving out of their home, then you will want to put another policy on their home. Your typical HO8, 2, 3, 5, for examples, have a vacancy clause there. Because there's an increased chance of loss to the property, the policy may exclude or limit coverage for property that is vacant. Vacant means the absence of both people and property from the premises. Unoccupied means the absence of people, so don't get that confused. A building is not vacant if they go on vacation, okay? That is unoccupied. Vacant means truly they do not live there. There is nobody there. There is no property there. Now, some things that are excluded are vandalism, malicious mischief is excluded if the dwelling is vacant more than 60 days. So you have that 60-day clause there. Okay. Now there's some other things that could be excluded like glass and any type of water damages. Okay. Any type of theft, any type of vandalism. All of these things are going to be excluded with that 60-day clause. Now, if there's a fire, it will be covered. If there's lightning or windstorm, it will be covered. But typically, these are some perils that are excluded with that 60-day clause that you have. Now, we've talked about Section 1 property. Okay, now there is also a section 2 in all your homeowner forms, but I do want to review a little bit, and I want to go over here to, I'm going to share my screen with you to the whiteboard here. And I just want to summarize this section 1 for you. So when it comes to having an HO8 form, okay, remember your HO8 form here is called your basic form, and it covers fire, and it covers lightning, and then it covers your wharves and vandalism and malicious mischief and theft. Theft is always covered, even under your basic forms. And remember, if this peril is not there, it is excluded. So we use the deer running through the house. So it would be totally excluded. Now, keep in mind, when it comes to these perils, we have these coverages up here. So under section 1, we have a coverage A, which is your dwelling, and they will give you the limit for your dwelling. And then you have coverage B, and I'm going to simplify this, abbreviate it, other structures, which is your 10% of coverage A. And then you have your coverage C, which is your contents or personal property. And that is, whoops, let's go back here. And that is 50%, okay, of coverage A there. And then you have coverage D. Now remember, coverage D is loss of use. And it depends on what form we're writing. Okay, so with loss of use, you have an HO8, and it is 10% of coverage A. All right, and then you have your HO2, 3, and 5. Okay, and it just depends on what state we're in with that. You know, it could be 20% or it could be 30% of coverage A, just depending on the state that you're in. Now, your HO4 is a renter's policy, so they do not have a coverage A. All right. So this is going to be either you're going to have either 20%, okay, or 30% of coverage C here. And then your HO6 is a condo policy. So you'll either have 40%, okay, or you will have 50%, just depending on what state you're in. And this will be coverage C as well. All right. Now, what happens here is let's talk about our perils here. So your HO8 is talking about your A, B, and C. What happens to it? Well, if there's a fire, lightning, wind, hail, aircraft, auto, riot, you have volcano, explosion, smoke, vandalism, malicious mischief, and theft. Okay, all of those are going to be covered under your HO8. Now, if you have an HO2, and this is called a broad form, then it's going to cover all those perils above plus the big effect, which is burglary, ice, snow, sleet, glass, accidental discharge, falling objects, freezing of pipes, electrical collapse, and tearing apart. And what the broad does, it includes all of these perils plus the big effect. Now with the HO3, they split it out. So remember, when it comes to your basic form, this is their coverages A, B, and C. And again, when it comes to your broad form here, this is also for coverages A, B, and C. All right. So when you have your HO3 form, what they do here is they split it out. And they say this is a special form. That's just what it's called. Okay. And on coverages A and B, you have open perils, which covers everything that's not excluded. And I use that radical example of a deer running through the house and tearing up your walls and your flooring. Then that would possibly be covered under your HO3 because it's not excluded. What is excluded? War, nuclear, flood, earthquake, power off premises, intentional, government. You know, all of those are excluded. And then your coverage C goes back to your broad perils. So your cover C is going to go back to all of these perils and these perils here. So if that deer jumps on the couch and damages your contents, then it's not going to be covered because there's not a deer under your basic or your broad. So what you can do is you can take this and put an HO15 on there, and now you have broad perils. Okay. Excuse me, now you have open perils. And so that takes that deer running through the house with everything. So you have an HO5 here, which is is called your comprehensive policy. And that means that your coverages A, B, and C are all open perils automatically. Okay. And then your HO4, which is your renter's policy, and your HO6, which is your condo policy. We're only talking about cover C here because, again, with a renter, you don't own a dwelling or other structures. And with a condo, your buildings are insured under a condo association. So it would go back to broad perils on this. Okay, so this is your section 1 coverages that we talked about. Okay, so I'm going to go back here to our PowerPoints. And we were talking about our section 2 liability here. So all of your policies, all of your homeowner forms have a section 1 and a section 2. And the section 1 is property, and then the section 2 is liability. So as you know, a homeowner can be held liable for damages arising from his home or yard. For example, what if someone comes to your house and slips and falls? Or your 6-year-old breaks a window for a neighbor? Or an individual can be held liable for their pets. Your pet bites a third party. Now, those are called third party, people that do not live in that home. Remember, who are your insureds? That is your named insured plus the spouse. Okay. It also includes their relatives that live in the home, like if a mother's living with you or an uncle. It also includes anyone that is in your care, custody, and control, age 21 and under, okay, like foster children. So these are called personal activities arising from the home. Section 2 is the same in all your homeowner forms. So it doesn't matter if you have an HO8 or an HO5, you're always going to have these limits and coverages. Coverages E is personal liability, is $100,000 per occurrence, and coverage F is medical payments to others, and it is $1,000 per person. Now your coverage E, this is personal liability, and this covers damages that the insured becomes, and this is real important here, legally responsible for or legally obligated to pay. And then your perils are going to be bodily injury and property damage caused by an occurrence. So it's bodily injury and property damage to a third party. What is bodily injury? It is sickness, disease, including required care, loss of services, and death. Property damage is damages someone else's property. Physical injury or destruction of tangible property, including loss of use. It is for non-business personal activities that can occur anywhere. It covers your insured locations, such as your premises described in the deck. So you are insuring 123 Smith Lane Road, that type of thing. It would cover that. Or residents that are acquired during the policy period. Or locations where you are temporarily residing, like a hotel. If you accidentally, negligently, we use that word, injure a third party. Locations and insured is renting for non-business use. If you rent a hotel and you accidentally cause injury to a third party, maybe you're giving a baby shower or a wedding. Vacant land owned by the insured, and any type of cemetery plots or burial vaults. The insurance company will also provide a defense for the insured at the insurer's expense, even when the charges are groundless or false. This includes any prejudgment interest awarded. So there is a defense cost for your homeowners as well, even if they are accused of something that they did not do. Now, medical payments is that $1,000. So you automatically get $100,000 per occurrence, and then you get $1,000 med pay automatically in your policy. And medical payments to others pays all necessary medical expenses incurred within 3 years of an accident. Now, you need to check with your state and make sure it's not 5 years, because it could be 3 years or 5 years. Most of them or 3 years. So your medical payments is sustained while the injured party is on your insured location. Now, you do not have to be at fault. That insurer does not have to be at fault. It could just be because they were on your premises and maybe they got bit by a snake or they got injured and you were not negligent. Okay, the insurer was not negligent. That's why you have med pay. Okay, but it is caused by a residence employee as well. So what is a residence employee? Let's say those are usually like a nanny. So if you have a nanny come into your home and they were to get injured, you do not have to have workers' compensation, which we'll talk about in commercial. If they're injured, they could go under this homeowner policy as well. Okay. So it's called guest medical because, of course, they're not covered. It's third-party coverage. So guests are the only ones that are covered, not your homeowner, not their spouse, not your children, not your family members that live with you, not your foster children that live with you. Okay. It's called guest medical because the insured or regular residents, other than the residence employees, are not covered under this. You can't sue yourself. Now, I call these exclusions pretty much common sense. Expected or intended is excluded. Again, business pursuits are excluded. You will need a business policy for that. Professional services are excluded. If you are a doctor and you get accused of malpractice, your liability on your homeowner policy is not going to pay for that. You as agents will have errors and omissions insurance. So if you tell somebody something is covered and it's not, you cannot go under your homeowner policy. Okay. Liability arising out of the ownership, maintenance, use, loading, or unloading of an aircraft or watercraft or motor vehicles. These are operations that you need to have other policies for. Liability arising out of the transmission of communicable diseases. If somebody accuses you of communicable diseases or sexual molestation or corporal punishment or physical or mental abuse, these things are excluded under your homeowner policy. So basically, it is third-party liability, bodily injury and property damage. Think slip and falls, think your dog bites someone, that type of thing. Now, there is a watercraft exception here. Again, that is boats. So if you own a boat and it is an inboard, outboard boat or engines that have 50 horsepower or less, and let's say that you, and again, we're talking about bodily injury and property damage, you injure a third party skiing, not one of your family members, not one of your spouses, that's called health insurance, or maybe you run into someone's deck while you're boating, that's property damage. But it has to be an inboard, outboard motor engine that has 50 horsepower or less for a homeowner policy liability to extend. Watercraft of an outboard engine of 25 horsepower or less, sailing vessels less than 26 feet, and then any watercraft in storage. All of these are your boat exceptions. The best place to put a boat is on a boat policy. But if you don't, this is the exception on the liability side. Now remember, on the property side, you had $1,500 for the boat itself. On the liability side, you have these conditions. Now, just like in your property world, you had additional coverages like debris removal, fire department, reasonable repairs. You have additional coverages here like claim expenses. The insurance company is going to defend the homeowner if they get caught up in a lawsuit. Any type of bonds, prejudgment interest, reasonable expenses that the insured incurred at the company's request. If they have you go and they need for you to go to some deposition, they will pay you up to $250 a day for loss of earnings. First aid expenses, damage to property of others. There is $1,000 for damage to property of others without regard to legal liability. So let's say you borrow someone's lawnmower and it gets stolen or gets damaged in a fire. And then just like we had loss assessment on the property side, we have it here on the liability side. It pays up to $1,000 for loss assessment on the liability side. So again, your homeowner association should have a policy, but let's say that there's a third party, they come swimming and something happens to them, they get injured and they sue all the homeowners. Okay, your insurance policy only pays for liability for up to $1,000. So the loss assessment is the same under Section 1 and Section 2. Okay, so going back over here to our screen, let's talk about our Section 2 coverages. So we know that there is a Section 2 in all your forms, and it is the same limit. Now, you can increase this limit with extra premium and endorsing it. So you have 100,000 per occurrence. So if you have some third parties you invite over to your house, maybe you're having a party and the deck collapse, okay, and you have a lot of third parties injured, those people will all share 100,000 per occurrence, 100,000 limit per occurrence. Now there is $1,000 for medical payments. So again, you do not have to be legally liable. Someone gets injured on your property. Maybe you were not legally liable. Here you have to be legally liable. But under medical payments, you do not. And it's just because they're on their premises, they will get $1,000 medical payments. And this is per person. Be sure to memorize that $100,000 is per occurrence and $1,000 is per person. So again, you have a Section 1, you have a Section 2 on your homeowner policy. It is a package policy. It has to be owner occupied. And that's the big difference between that and your dwelling policies, which we'll go over a little bit later. Okay, going back to our PowerPoint here, this concludes our supplemental material for, coming back to you here, this concludes our supplemental material for your homeowner policy so that you can get your certificate for your pre-licensing school. And then hopefully this prepared you a lot for your state exam. I want to encourage you, this is the motto in my school, whether you're taking the pre-licensing from me or whether you did the supplemental material, the key is to prepare, and repetition is so important. Repeat, 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 and this will give you confidence. So stay positive, work hard, make it happen. All right, so we will go to our next supplemental material, and I will see you over there.